$18.5 billion moved quietly on a Tuesday morning while you were checking your phone, and not a single news anchor mentioned it. It started with something called a repo operation, which sounds boring, so let me translate it. A repo is basically the Fed handing a bank a bag of cash overnight and saying, "Give me your treasuries as collateral, and tomorrow you give me the cash back." It's an emergency ATM for banks that are quietly running low. Now, the Fed does these all the time, usually for a few billion, barely noticed. But on February 17th, 2026, they pumped $18.5 billion in a single operation, making it the fourth largest liquidity injection since the COVID pandemic. Not since COVID, since the pandemic. That's your comparison group. And here's the part they buried in a footnote on the New York Fed's website. No press conference, no announcement, no primetime alert, just a line in the daily operations data that most people never read. Banker, routine operation. Reporter, so banks are fine? Banker, completely routine. What could go wrong? Everything. Enter the repo market. Invisible, unglamorous, and the actual plumbing that keeps your bank account from freezing overnight. Here's the thing about plumbing. You only notice it when something starts leaking. And by late 2025, it had been leaking for months. On October 31st, 2025, yes, Halloween, the Fed injected $29.4 billion in a single day, the largest repo operation in over 2 decades. Then, December 1st, another $13.5 billion. Then February, $18.5 billion. That's 3 massive interventions in 4 months, and every time the official statement was the same word: routine. Meanwhile, U.S. bank reserves had quietly dropped to their lowest level in 4 years, $2.8 trillion, right at the edge of what analysts call the ample reserves floor, the minimum cushion needed for the financial system to function without seizing up. One analyst described it as the Fed quietly backstopping a system showing fresh signs of strain beneath the surface. Not a panic, not a crisis yet, but the fire extinguisher keeps coming off the wall. That's the detail nobody wants to explain. Here's where it gets uncomfortably familiar. December 31st, 2025, the repo rate spiked to 3.87%, with some transactions hitting nearly 4% above the Fed's own standing rate of 3.75%. So banks were borrowing from the Fed, then lending that money back into the repo market at a higher rate, essentially arbitraging the central bank's own emergency facility for profit. That's not a glitch, that's a symptom. Marcus, the portfolio manager, refreshes his terminal. The overnight rate is spiking. He's seen this before, September 2019, when the repo market froze completely and the Fed had to intervene for months. He sends one word to his team: watch it. They weren't panicking metaphorically, they were watching the same pattern replay in real time. And the last time this happened at scale, it was a quiet prelude to something much louder. Actually, the crash in 2019 wasn't the accident. The repo stress was the warning that everyone filed under routine until it wasn't. So who pays if this becomes something more than a footnote? Not the banks. They're borrowing at the Fed window and walking away with arbitrage profits. Not the executives. They got their bonuses while QT quietly ended and the balance sheet started expanding again. The people who pay are the ones who never knew the repo market existed until their mortgage rate didn't drop, their small business loan got denied, or their savings rate quietly flatlined while inflation kept moving. The Fed will call every single one of these injections routine, right up until the moment they stop being routine. And the uncomfortable truth is that you and I have no way to tell the difference from the outside. The standing repo facility, the emergency liquidity tap the Fed built after 2019 to prevent another crisis, has now been used 3 times in 4 months. They built the fire escape because the building kept catching fire. The tap is still running.